Good afternoon, this Thursday, August 27th. Well, interesting day today. After yesterday's explosive continuation grain rally, they could have really got on the grain trade this morning, and they tried, but they couldn't do it. Soybeans holding after breaking back into the old high level of 1250, 1256 on the continuation chart, heading back up towards the highs the day later in the session. The wheat trade, they tried to put that under pressure early today, didn't stick, went back to the better levels of the day and the week. And also corn. Corn did close lower, and they tried to push it lower earlier in the session, 7, 8 cents, and midday rally to unchanged. And you could say, well, it's still closed lower. Yeah, but when we get to the charts, you're going to see it's just an inside day. It's inconsequential, especially with the losses trivial compared to yesterday's gains. So what's in play is that Putin, basically, he's gone to war with Ukraine. No more conversation of some kind of grain corridor for peace purposes for the world. He is angry. He is mad. And Putin doesn't taco like Trump. Trump always chickens out. I guess you would say Paco. Putin always chickens out. He doesn't. He says it, he means it. He's going to war because Ukraine has found his Achilles heel, and that is the refinery process of his oil. And with diesel supplies so short, and they're banning exports of it, it has a hard time fighting a war without diesel. The tanks, the trucks, they all use diesel, but they also need diesel to harvest their wheat crop, which some have estimates that maybe only 60+% of the wheat crop will get harvested. And then what's to say about getting the wheat crop planted with supply so tight? These are variables that can be very strange going into next year for the new crop wheat next year if we find out that they went into winter with less when we planted. Now, granted, they can ship some spring wheat down from Siberia and stuff and plant spring wheat, but right away you got a problem because spring wheat produces less than winter wheat. So this is a dichotomy that the market's got to work through. And never mind the fact that if we look at the corn pricing, that the yields are coming down and demand is likely going up because now Ukraine is going to have a hard time getting their corn out, especially over to Europe. I mean, yes, they can send it up the Danube River, which now has low levels. The drafting is low, and so expense is high because the Rhine is low, the Danube is low. So it's not like that's just an easy run that way. And as far as getting corn and the wheat trade out of Ukraine via trucks, well, good luck with that. You think they're going to run down the road at 80 miles an hour with a trailer and a pup behind it? No, it does not work that way. They have mostly gravel roads, and they're in bad shape. Potholes and roads are either bombed or bridges are out. So it's all roundabouts. They have to get to other areas. It's a very tedious process. So our corn demand, by default, argumentative or not with me, our demand is going to be going up and our yields are coming down, and our carryout is probably heading to 1.2 billion bushels or less. Stocks to use crowding 7%. Well, that means ultimately into the first or second quarter, we could see corn prices knocking on $7. I mean, I've just been discussing $6, but as we're threading this basically tapestry of what is to look like the final quilt for the crop year, you can start seeing things going wrong. Oh, and I haven't even brought up the Super El Nino, which affects northern Brazil, most importantly, Mato Grosso, the largest bean and safrinha corn producing state in the country, could affect their production of corn next February, March, and April. Interesting. That's when we get our highs in grains, that second quarter, April, May, or June. So follow along with me on this little journey as we try to keep walking our way through this grain trade, and we'll get to cattle as well at the end of the video. All right, let's get going quick. These videos get too long. Corn, we are in a wave 3. Wave 3 should be longer than wave 1's. And so wave 3 matched up at 524, which is why we're anticipating more. We're expecting at least a 1,382% of this wave. And so as we take a peek at the corn weekly chart, we also have a 38% retracement of what was this high? Oh, that was Ukrainian-Russian war start. And of course, this rally is what? Ukrainian-Russian war. So it would stand to reason we could throw a Fibonacci off that high to our low made in 2024. And lo and behold, 542.5 comes in play. And our measured move theory to 1,382 comes to 548.5 or 48 3/4. And then you have 550 psychological. And then you can bump that. Let's just say 542, 552 would be a good number for this first leg up to run into a little trouble. We reflect that here on our 60-minute chart. You can see here 548 3/4, or let's just call it 552 for 5 waves up on this leg three. 3 of 3 had our gap in it. There she is. And so that isolates that trade. Fourth wave had a failure, an A, B, C down fourth wave failure. They couldn't plug the gap, which vaults us likely to something near 550. Whether it's 554 either, I'm not going to split hairs, okay? Something up here is creating a wave 3 into the new month. I always talk about the last day of the month, first day of the month. That's next week, Monday, Tuesday. We can charge something in the Tuesday, whatever. Then the market does some kind of fourth wave congestion pullback. They can be really long in length, or they can just be a fourth wave break and then another fifth wave up. And I wouldn't say that this is the fifth wave high. To me, fifth wave is a series of 5 waves higher, taking us north of $6. And I think 6 is in the cards. We'll discuss 7 as we go into the winter and see how our demand is coming from Europe as they buy grain from us because of their shortfall. And we'll see what Brazil's having issues with or not. Remember, forecasting weather, it's like fortune telling, okay? We'll see how it plays out. Soybeans, I like this. Breaking out on the continuation chart, a quadruple top. We showed you on Tuesday that, you know what? They're slapping at it and pulling back. That's going to run through it, and it did. And this opens up the prospects of wave 3. We've been talking 1330, 1360. Yields are likely working lower. Just a 1 bushel drop in yield gets us into teen town with soybeans. Anything close to 200, at 220, 230, you're knocking on $13 plus. I like on the daily chart here on beans how they did hold and actually pushed a new high today. They could have broke them, and they tried early this morning, yet they came back late in the day as we were waiting on some announcement from the EPA, helped firm up the soybean oil. Who knows? We're going to get more gallons applied, or at least a 1.2 to 1.4 billion gallons, I think it was. Yes, that could on the SREs coming. So this is friendly for beans. Bean oil coming back into life, along with soybean meal, could be pushing us. Also, channel line, this is just kind of a heads up. If you pop these channels when markets spike, they'll run into a channel and come off. So spiking here, 1280, but we got to be careful here. Now, as we go forward in time, that channel still rises. It's just kind of like a bumper if you get going too fast. If you go through, well, then you're going parabolic. So just be careful. 1280, 1285 could be something on the upside for another stall out. Wheat, all right. Limit up yesterday. They opened last night, traded lower and this morning, and yet still managed a good close. Not near the night session highs, but they got close to it. Our 60-day cycle glaring out here comes in on Tuesday, September 8th, because there's no markets on Monday, September 7th. And yet next week here, we'll see here, opening of the month also could bring something. Now, I noticed something on the charts today, and I'm going to show it to you. It's a little like watch out for it. When you measure that first leg up back in January, okay, and you do this, and you just do matching moves, well, watch what you come up with. I did 3 of them. This one here was shorter, okay? But this leg, and this leg up to the overnight high are perfect matches. Now, it could spook you a little bit that, oh no, we got a high here. Maybe we do, but maybe we don't, because you got to understand, these measurements here didn't occur on a pinch. We're starting to work into a pinch right now. With the Black Sea shutdown, I don't know if I'd give this a lot of weight. What I am giving weight to is that this was the start of the Ukrainian-Russian war, the current Fibonacci retracement of at least a pathetic 38% retracement is near $8. And so that's why I think this run at least makes it to $8, which starts to reflect a pinch. And, a war-associated Fibonacci number starts to make sense because what is it? A Ukrainian-Russian war. So if we're not climbing tomorrow, trying to best today's highs, that would be a bit concerning with what I just showed you. But I think this is more targeting on the short term, $8. Get to Kansas City wheat, also that 60-day cycle. I think something near 850, reflecting current spreads. And the KC weekly chart, we're already at the 38% retracement. That's because we had the drought and lower stocks. We could bump up here. Whether we get towards 50%, isn't this cute here too? 50%, look at how that lines up here. So that's up at $9. I think that's our reaching target here later on is $9 on Kansas City wheat. If you're getting value from this video and want more, just check out our daily newsletter. Each morning we send a market summary to start your day, plus deep dive analysis, trade alerts, breaking news, and videos just like this. Whether you're a farmer, trader, or just tracking the markets, it's a great way to stay ahead. Start a free trial by scanning the QR code on screen or clicking the link in the description. Call us at 701 222 0221 or visit heartlandinvest.com. All right, let's go to cattle. Now, first we got to state, okay, after the top, we do have 5 waves down. 5 waves are in play. A matched 5, when you do the first leg down, do a perfect match, says 407.80. So far, I got down to 207.80, excuse me. 209.50 was the low so far in October cattle, and it's bounced a little bit. Whether it comes back down, makes new low or not, we'll see here, but I think we are close to a turn if we already haven't turned. But what I want to bring to your attention, as we look at the deferred cattle, okay, here's October, and soon to come on December, and then eventually February. And I think February cattle is the one doing this kind of stuff out here, recovery bounces. I've got to bring to your attention, okay, December cattle, they're tracking a $2 premium to the October, and February cattle are tracking a $2 premium to that. But here's the joke of it, okay? August cattle, which are soon to expire, they're trading at 220. The 218 bids yesterday, JBS jumped to 220. Looks like cash trade, probably in that 220 range. And that's where August cattle are going to go out. It's kind of a joke to think that February cattle are worth $3.20 less than where the August cattle are right now. Because here's the thing: the 300,000 metric tons of beef trimmings, I should say, that Trump is bringing in to help the election, we know what a joke it is. Consumers have other choices besides eggs. They can buy cheap chicken, turkey, or pork. They don't have to buy hamburger. It should be their choice to buy hamburgers. But whatever, he made his decision, we move on. The reality is that's gone end of November. Also, the calves that are coming in from Mexico, maybe there's some 700-800 pounders in there, but they don't do so well when we get towards our winter months. And so I do not believe any of these calves are going to be dying or harvesting late January or beginning of February when we go deliverable, which leads me to believe that if you understand the birth-death cycle, they're not the same amount of calves born every single month, 12 months out of the year, that all months are created equal. February is not equal to the June, August cattle contracts, because that's when the bulk of the cattle get killed. The numbers will back off in February. Our demand will likely be as good as it is now and later in February, unless we go into a recession that I'm not aware of at this time. The Federal Reserve doesn't think so. That's why they want to leave interest rates up, because there's no recession. Okay, well, walk with me here. If August cattle are worth 220 right now, and February cattle have no hamburger coming in, and there's very few Mexican calves dying in January yet into the opening of February, and we could get a storm in January, which is tough on Mexican calves and Southern calves, well, guess what? This is kind of a joke. We should easily be trading above 220, okay? Possibly trading closer to 230. And here's something I like on the February cattle chart. You take the February cattle chart and throw a 62% retracement on here. When the initial Tyson news came out, it held the 62% to the tick. I got pretty excited about that. Then we had Trump's Black Swan event. Okay, well, here we are, pounding it, and yet, as of today, basically kind of holding in here. So what I'm saying is I like February cattle. Anything under 215, I think, is a buy in here, and we're going to eventually see this market start to recover. And on the weekly charts and the continuation charts, I think February cattle is what gives us that rally that I had shown recovery before we move lower again next year. Now we step into feeder cattle. They're always harder to do because of the layered discounts with the border openings. We have Santa Teresa in New Mexico opens up on September 24th. If nothing goes wrong, we've been open for 4 days so far. Nothing has went wrong. If that stays in place, and then it's Columbus or Columbia, New Mexico on October 24th. But the point is, ultimately, we'll probably find the January and March feeder cattle contracts below 300. But in the near term, I had this target of 303 to 306. Well, November feeders are not on this chart yet for a couple of weeks, but they're dancing around down there trying to find legs. Now, October's could head down here because of corn pricing, but somehow, some way, we do get a lift in the fall cyclically with the cattle, and whether that high comes as they like to come in at, around late December, early January, then we move lower in the new year. Again, this is not to calendar spec. All of this is not to calendar, okay? It's just reflecting wave potential rallies. I think the prospects of seeing possibly the November feeder cattle working their way back up to something near 330, well, we fell through, and you've known how that, and then, of course, Watch this moving average find its way down there in time. That's when we focus on getting January sales on again. As likely, January, March feeder cattle will be into that 280, 290 range. As I showed you earlier in the week, when this whole Mexican border thing got started, well, we were in that 260 range, 270. So you can start to see how, as we get back to normal, as long as consumer demand is remaining strong, feeder cattle probably will find legs, but it might be under 300. This is Eugene Grainer with Heartland Investor Capital Management. I hope you find this information useful.